Good ECB day, everybody. I think I've got it right now. Good morning, Hugo, Brock, Sansi, everyone. Okay, let's take a look around. See how the euro's reacting. Initially down 4 here. Yeah, so far not that constructive. I guess I thought we might have one more spike underneath here. Blake's falling wedge here. So we'll see what happens with that. And oil now getting closer to a sell zone. I warned that it could, rally back to the prior low of 70 or so. Hello, Sinatra, Sansi, and Scott, everybody. So prior lows were right around here, and ends down a couple. I wonder what's the reaction across the pond there, Ryan, to what you're hearing on the ECB. Oil looks like the Russell. I don't see the parallels. Are you with us today, Ryan? Getting a nice pop in cable, and EG is starting to pull back to where it might be worth a shot risking the lows. So I don't believe Ryan is here. How about Blake?
Hey, I'm here. Ryan, I believe he's having some the power outage issues.
Okay, buddy.
Yeah, and I'm just trying to put in a pattern in place. So
Oh, okay.
I'll see you
All
in a
right.
few minutes, okay?
Go ahead, buddy. All right. So just a couple of things on the stock indexes here. NASDAQ has broke through the 61.8 and now it's at the 78.6, and S&Ps have exceeded the 78.6. So I thought we had a high last week, guys. I mean, the jury's still out. NASDAQ weaker than the S&Ps. And speaking of the Russell, I know a lot of people think it might end up making a new high. When I look intraday, this could still be just a bear market rally in the Russell. Okay, so just because it's 61.8 at 32.50. Okay, Sanse. And we're getting a little bit of a pullback in Bitcoin, and maybe that was it down there. Looks like it was enough to. I had some type of. There it is. It's kind of a falling wedge. The bottom line didn't get tagged, but it's trying to come out of here. This is where I had it anchored. So, we're trying to sneak above this wedge line here. I thought we'd go back down and fill this out at 26. Hi, Ryan. Okay, so Ryan's here. Ryan, anything? Are you back online?
Yeah, just about. Just, I don't know why.
Okay.
Just got some power trips going on. Yeah, so if I disappear, my apologies.
Oh, no problem. So, what are you seeing as far as reaction to ECB? Everyone waiting for the press conference. It sold off a little bit.
Yeah, we've had this comment in the statement saying that they're now tying rate guidance to actual inflation rather than inflation expectations, which has been a huge part of the ECB's makeup. The mandate and everything. And so there's a few questions being asked about that because, in theory, that means one inflation print or two inflation prints, and we could be at 2%, which is their target. Which, if this line is correct, that means that they could hike. But obviously, we know that they're happy to let inflation run hot above 2%, a bit like the Fed. So it's a bit strange. So I think that the market initially took it as hawkish. It's having second thoughts now, but this is one of those things that we need Miss Spraytan to explain for us.
Okay. Any view on what should be done with euro here? Do you think we're bottoming, or we're going to get, maybe one day you'll pull up the screen and we could see your setup, Ryan, and kind of the things that you look at, and share your charts with us. So here's a daily. It looks like it wants to push to new lows here. Here's the 4 hour. But you know, it's been diverging since here. I know there's not that much to talk about. It's been in what 70, 80 point range for a long time.
Yeah,
So
yeah.
what do you think? New
Um,
lows coming?
it all depends on what she's going to say. You know, she could turn around and say, yeah, you know, if inflation does sit above 2%, and you know, then we could look at raising rates. But you've got to think that's an impossibility. I think we're going to be stuck in range here. We could see that wedge breaking to the downside.
Okay.
The next level I've got is down at 117, 116.95. I think there's a fib down there of the swing up from last year.
Oh yeah.
So that's going to be the next level.
By the way, good call on Euro Pound yesterday, Ryan. Look at that. So
yeah, I wish I was in it. I was waiting for a move up to 87 to dip my feet in, but you know, traders' luck, you don't get the levels you want. But I'm still core short. So the way it goes down is good for me. We're into this key zone again, 30.50,
yeah.
which I expect it to play up again. It's been one of those really sticky areas. Get through 30, and perhaps we can have a look at 8,500, 84.80, and that magic line that I've been waiting ages to break.
Yeah. Okay. All right. So cable still strong. What do you think is behind this rebound we've had here in cable?
Well, this is a strange thing, and we were watching it yesterday. You know, we got the rebound in yields, and that's continued today. And you know, it makes a bit of a mockery of the reasons behind it. You know, the last couple of days, people were saying virus worries. You know, that's going to affect growth and lockdowns and so on and so forth, and that's why we've seen this risk on move. Well, what's happened today? Has the virus disappeared and we didn't know about it or something? And we've seen this risk rally again. You know, so it's what we're talking about. I was talking about with Blake and the others. It's this goldfish mentality again in the market. You know, one minute the world's ending, next minute you come in and you think, well, what happened to that? Regarding the pound, what we've been seeing for a while is because the volatility in the pound is just that much higher than the euro and dollar yen and things like that. You get these larger moves. So whereas, you know, euro dollar may move 20 pips, that means 30, 40, 50 pips in cable when there's a dollar move.
The goldfish market seems to say that when you have it, you take it, and maybe short-term trading, lower time frame trading is a way to go in this environment. Is that what you think, Ryan?
It can be. I don't think it's helped the last couple of days because, you know, you're relying on levels even on the short term, and you think, okay, well, that was a support point. Maybe it's term resistance. It looks like it's term resistance. You think, right, well, maybe try a short there. Boom, you're blown for 20 pips. And then you think, okay, you know, that's not working. The thing is, just as I mentioned yesterday, you get these periods where you get no volatility, then you get a big volatility injection. And, you know, as traders, you either want to know that one thing's happening or another, because then you trade accordingly. But when it switches day to day, you know, today you can't trade the pound with 20 pip stops.
Yeah.
You know, 2 weeks ago you could.
What can you trade with 20 pip stops? Not much.
Dollar yen.
Dollar yen. Okay. View on metals, Ryan. I'm seeing gold. You know, silver already broke down, but gold's sitting right on this major support line. Almost looks like a little mini head and shoulders. If we break down here in gold, it measures back down towards the lows that we had before this rally. What are you thinking here?
Yeah, I think that's a possibility as well. Again, you've got to watch for being faked out in breaks like that. You know, again, you know, like we're saying, this is again another asset market where you can perhaps go with a tight stop. You know, you break that line and you get confirmation of that broken line. Fine, yeah. You can look at shorts, but you're not going to give it much room if it comes back above sort of, you know, this 1795, maybe even 1800. If it gets back above 1800, you know you're likely wrong and it's been a fake break.
Right.
What I find is that, okay, yes, you can trade with tight stops if the market's going, but what you have to do in that instance is really try and push it if it's going your way. So if you get a break of this, what are we going to call it, 1794, 95?
Yeah.
Yeah.
right there.
Yes. If you get a break of that, if you get $5 out of it, lock in some profit. Maybe bring your stop down to break even. Protect what you've got. So if it does turn right around on you, if you get stopped, you're stopped at break even, or you're going to put something in the bank. Once you lock in some profit, then you're in easy street. You can sit back and relax. And then, if you get a move down to sort of 1780s, fine. You bring your stop down behind it, you trail your stop, you take a bit more off, and you keep pushing and pushing and pushing, but protecting yourself behind.
What do you think about this recovery in the S&Ps after the turn we had last week and lower on Monday, and then boom, here we are? Could this be a failing rally in S&Ps and NASDAQ, or are new highs a layup?
Tell me, Dale, how many times have you seen this pattern?
1 million times.
Exactly.
Do you have a view? McConnell said he's not going to raise the debt limit. I think that's at the end of the month. I mean, they raised it every time under the preceding president. They've always raised it, except we had that one time where I believe they didn't. We got a downgrade in bonds. Do you think the way politics are here in the U.S. that that could happen? That things are just so bipolar that McConnell would stop rolling the debt ceiling, and we end up with a downgrade in bonds after this big rally, and maybe that's what could be behind a big break. What do you think would happen if they didn't raise the debt ceiling?
I think you could potentially see something along those lines. Politics is politics, as you said. They were happy to do it. The shoe was on the other foot under the other president, because on the other party, because we'll raise the debt limit. Well, the Dems are saying, well, we're not going to have that. We're going to vote against it. It's all the usual horseplay, and you'd think, on balance, they'll get something sorted at the end, because it's going to affect the recovery. It's going to affect, I believe, the wage support, the job support that's in there, because if you start closing down all those programs, and if people aren't going to get their checks rolled out because federal offices are shut again, that's going to be a big bit of damage to the economy. And I don't think either side is willing to be the one that causes that. So we're going to get the usual chest beating. We've got 8 days till the end of the month. Then it may run over, probably will run over, because even that's not a real deadline. In effect, they can tack a few extra days on.
I can't say this, Ryan. What do you think of this? I mean, the S&Ps are on the verge of making bills. Okay, Scott's saying no debt ceiling raise, but the S&P is being close to new all-time highs. I think 30 handles away. Look how far away we are from the lows in the VIX. You ever see a pattern like this? I mean, it is getting the VIX, after being quiet for so long, seems to have a heartbeat. It's become a trading market, and it seems like the bias is to the upside after we had all this accumulation happening here. Could the VIX be giving us a message about the debt ceiling?
Possibly. Again, it's the thing with the VIX is, at the moment, it's there's so many things in play. There's so many things you can jump on. Central banks are doing whatever. You've got all the politics, as we're saying. We've got the economic problems. A job's going to recover, or are they going to stay soft? Is that going to keep the Fed behind? So I think what we're seeing with these VIX moves is just when you hit each individual item, if you like, then you're going to see these moves. Just a question for you, Dale, because you're in the US. When summer recess? Is it all of August?
Yeah, usually, yeah, they're gone until after Labor Day.
So that I think is the question. Are they going to get something sorted before then? I think it's like Labor Day, which is Wednesday. Is it like the 7th, 8th August or something like
that? Labor Day is September, early September.
Okay, so it's going to be most of August. They're shut then.
And
Yeah.
I
So
think hey Ryan, good morning. And something
Blake.
I was reading regarding this. I think that that they go on summer recess, don't they? In Congress here in the next week or so.
Yeah, the end of
In
the
that
month.
week or two. Yeah. So I mean that's the kind of
Well, they're
over.
tired from all their
Yeah.
fighting.
What's that?
They need a vacation from all their everything they've
Yeah,
gotten
yeah.
done.
I guess they probably do. But that's I mean, is that something that really I've remembered in the past, Ryan, and you can refresh my memory if you remember differently. But when we have some of the U.S. government agencies, it's more of scare tactics, and then people stop getting paid, and then they get paid retroactively after the fact. It's not as big of a deal as I think people tend to make it a big deal. Like market participants, like what if we stop paying our debts? What if they can't come to an agreement? How about if the government shuts down? I always recall people raising those fears, and then the market, especially the FX market, where everybody's like, oh, I'm going to short the dollar, or oh my God, it's going to be risk off. And, the markets just kind of pave over it because they know that something's going to get done. It's not like the US is not going to pay its debt, and then we're just going to go, belly up and that's it. You know what I mean?
Well, maybe it's different though, Blake. Confidence in the
It's always
US
different.
globally is shaken.
In any case, Blake, the perception of market participants about what makes sense and what not is extremely distorted. For example, if for some reason convincingly they decided that they're not going to raise the debt ceiling again, that would be the first time that it would make sense to buy the US dollar, if you're asking me personally. I know that the initial reaction from the markets would not be that, obviously, right? But inflating your debt away and raising more debt to pay the previous debt is definitely something that has never historically led to sustainability medium to long term.
So why would you be along the dollar? Tell us why.
I wouldn't be long the dollar. I said it would be the first time that it would make sense fundamentally to start looking into a longer term perspective, simply because that would be the realization that you cannot keep living beyond your means forever. And it would be time to reevaluate how you balance your books and build a proper economy as the US used to have a proper economy, right?
Got it.
Yeah, as simple as
anyway,
that.
Well, good morning, guys. How are you? Ryan, you had some comments really, and I'm going to shift back over to the ECB because we have the ECB press conference coming up in a little bit. Notice, by the way, the euro dollar continues to stay in this wedge, and I think the market got a little bullish here following the ECB statement. Wasn't really too sure why, because Lagarde seems to be tying policy to interest rate inflation expectations. So what do you make of that at this time? And maybe Ryan and perhaps Steve afterwards.
Yeah, we were just talking about that at the start. It's this seemingly strange comment that it's going to be tied to the actual rate of inflation or forward guidance on rates to the actual rate of inflation rather than expectations, which has been a big part of the mandate of the ECB. It was taken as a hawkish comment. Then you've got to wonder, well, is it actually achievable? The thing with the ECB, they can always do the famous switcheroony where they go from headline inflation to talking about core inflation needing to be at 2%. That's one of their trick cards they play. But this is something that, as the market is talking about, what does it actually mean? Because as I mentioned earlier, one or two reports and we could be up and over 2% inflation. Well, according to that line, that means rate hikes are coming, but we know that's not going to happen. So how's it going to be explained away by the suntan queen is what we're going to have to wait for. I think that's what the market's done here. He's had that bullish spike in the euro, and then everyone's gone, well, hang on a minute, they're not going to turn around and raise next month. So that's got to be rubbish. But here we are, one comment in a statement, and now we've got to wait for chapter and verse from the head of the whole show.
Steve, what do you make of these headlines?
You know, I'm extremely skeptical in trying to interpret any type of headline coming from a central bank as potentially hawkish. So I'm even I'm even suspicious that probably means that they expect inflation expectations to be much higher than inflation temporarily. You know what I mean? So in essence, that was a dovish comment instead of a hawkish.
They did make some dovish comments as well, right? So they did say they revised the forward guidance to underline the commitment to persistently accommodative stance to meet the inflation target. And this kind of wording doesn't look like they're a few months away from tapering or doing anything hawkish.
Thanks for
I think they're in the same boat as the Fed. They're faced with higher inflation. They've just shifted their numbers around to say, okay, we're happy with higher inflation, but the market's going to do the same as they did with the Fed. Well, what's going to happen if inflation is higher and if it's more persistent than you want? What are you going to do about it? And the Fed came out with their rubbish. Well, we're not putting a numerical value on AIT, and we've got tools to deal with it. Well, what bloody tools you got to deal with it? The only tools you got is these rates. So it's the same question. Yes, it might be temporary. What if it's not? What you going to do then? And if those sort of questions get asked at the presser, maybe we'll get some decent answers for a change.
I don't think so. Well, at least the Fed, whenever they gets asked this type of questions, Ryan, unfortunately, we get non-answers in essence, because how can you answer something that, So I'm not very optimistic. I mean, first of all, reporters that are being allowed in usually throw very soft balls, and on occasion when you actually have a proper question, you don't get a proper answer.
Yeah, remember the guy Pedro da Costa who asked this really nice question, then he was not allowed in again or something like that.
That's how it works. That's how it works.
I mean, he's probably one of the best. I used to be a Reuters reporter. Yeah. I remember that. All right. Well, we've seen this. We've seen the euro still contained, and I still think we need to be looking at 118.25, 117.50, maybe even slightly below that. Just remember, we've been in this wedge all week. I've been so impressed that the euro's been contained. I'm assuming it's going to be breaking out today. We've had this big move in the sterling. I was trying to play it on the short side. We're almost at the 618. It didn't work out, by the way. We have this big possible false breakdown from the last couple of days below the 200-day moving average, little double top false breakdown, and then we bounce back, and you can really see it through the euro sterling as Ryan pointed out yesterday would fall from resistance, and it has. So we've seen a big move there. But really, we've seen one of the biggest moves that we've seen this week has been crude oil. So, crude bounced from the $66 level, and, we bounced right back into, we're up against resistance right here. But what do you make of these such big moves? I mean, I know when you're talking about the S&P, for example, we're in this, wedge, and we continue to hold wedge support. We couldn't break through support, so that lifted at pretty much all assets, it seems like. But I mean, if you miss, let's say crude, if you miss this 10% move in crude, I mean, do you get long right now, or what do you do here? What are you guys thinking at this point?
Sell it.
Sell it. Dale says sell it. What do you guys think of first of all, these moves that we've seen? We're starting to see volatility pick up.
Yeah, I mean, again, as I mentioned earlier, it's this goldfish market thing, goldfish thinking. Yesterday and the day before, all these moves were about virus worries. Well, where's the virus gone? Has it suddenly disappeared and everything's right with the world? So it's I liken it sometimes to, that Newton's cradle, where you pull the ball one side and it pings the other side. And that's what markets are like. They ping one side.
I like that.
And, slowly it settles down in the middle, and then you get a almost normal market.
Yeah.
So, is this the end of what we've seen the last few days? Is oil going to go back up to $75 or new highs or whatever? Questions that all traders ask. I think you've got to look at it in simple terms. Just looking at the chart of oil that Dale's got up there. We've got a low in play around 65. That's our marker now. Doesn't matter what you think. It doesn't matter what you do in the middle. That's our main marker. That 65 level area was support for a reason. That's where we look at. If we break below there, fine. Then we're obviously going to see some more downside. In the meantime, we look up towards the 75, 76, and the highs. If we get up there, if we don't break, potentially we've got a range to play. So from a trading perspective, we let the levels do the talking. And if they're going to break, then we go with it. If they don't break, we've got a range to trade.
It's interesting that you point that out. I want to reference something, guys, that's coming out probably a little bit later today. This is going to be our Traders Summit. This is the Traders Summit interview right here. This Traders Summit interview was done yesterday. Brent Donnelly's awesome. He's HSBC, ex Lehman, ex Citi Tech. He's awesome trader. And he talks a lot about those concepts too, about, because we discuss a lot of things. I go into, algorithms today, and, the mentality of just having so much to look at, and where do you really focus as a trader. And he's got a lot of great insights. So be looking for that interview coming out a little bit later today. But you're right, Ryan, you just got to really focus on the levels. You got to focus on, the levels that make up that particular market. Like I sit here and I look at the euro, and I hear it's funny, whether it's people on Twitter or people in their chat rooms, just, oh, the euro's going to go here, the euro's going to go there. And it's like, dude, it ain't going nowhere until it breaks out, right? It's contained by price action right now. And you can assume and try to, get yourself in to the market like, 15 minutes ago when people were like, oh, here goes the euro, it's going in 119. Well, you've just been whipped around, 25 pips right after saying that too. Making the assumptions we're going to move somewhere until we see a nice, break from key levels. You're just kind of stuck, and you just got to wait for those breakouts. And I think the euro has been a perfect example of that this week.
Yeah, I think one of the main negatives for a lot of traders is they trade I think it's going up, I think it's going down.
Yeah.
And we've all got ideas on where we think the euro is going, or any currency or any market, and we use whatever we use, fundamentals, price action, whatever. But at the end of the day, you've got to bring, when you trade it, you come down to simple things, like you're showing there. You've got a wedge, okay? You can either trade the edges or trade the breaks. That's it. You've got two levels there you can trade.
Yep.
Doesn't matter what you think, what I think, what you think, what Dales thinks, all good analysis. But when it comes down to trading, you're either going to sell it at the top, buy it at the bottom, or you're going to try and go with a break. And that's trading in its simplicity. That's all we have to look at.
And again, I got to reference that interview, and you guys are going to be able to watch that. I think later today we should have that published. It's funny. Brent and I had this exact same conversation yesterday. It's like, you gotta, it's those, we were having a conversation about how smart people make bad decisions. Because that's one of the chapters in his book, and basically it's coming to a conclusion based off the analysis you've done. But a lot of times people try to outsmart the market, thinking they know what's going on versus anybody else. It's like price is going to really drive what's happening, so you got to wait for it versus trying to anticipate sometimes. So, and I think in today's market it's very, very true. Let's talk a little bit about, really quick, before Dale has his interview here in a minute. I want to also point out that the dollar Canadian, this is a big move that happened yesterday. This one, I tried to buy it after we had I thought was going to complete an AB equals CD, and I was trying to be cute and play that to the long side, on some supports. And you can see it right here as it cracked through, and it ended up taking me to the woodshed yesterday, having almost a 200 pip, like 170 pip trading range yesterday. Those moves are crazy when they come out of nowhere and it's not news related. Although, crude oil was up, 5% yesterday. But man, that dollar Canadian move was really, really brutal.
Blake, data in 3 seconds.
Okay, let's do it. Hold on. What do we got?
Surprise.
Jobless claims.
Yeah. Oh, worse than expected.
Red.
419 versus 350 expected. Previous revised a little bit higher, and continuous jobless claims 3.23 million versus 3.1 million expected.
Thank you
worse
very
data.
much.
That keeps the trend going and continuing. So that's not too bad in the continuing claims.
All right. Well, there you go, guys. Hey, Ryan, I hope your power comes back online. I know how it is. Sometimes this could be so frustrating. Steve Stelios, I hope you guys are, having
Don't lose your power.
not losing power. I'll see you guys on the morning edge. Dale, thank you very much, and have a great interview with Eric. You're interviewing today. Eric. Have a great interview, and guys and gals, I'll see you in about 45 minutes on the morning edge. So,
bye, guys.
Bye.
Okay. All right. Take it easy, Ryan. Steve, thank you. Eric, welcome to Face.
Hey, Dale, can you hear me all right?
Got you loud and clear, Eric.
Great.
Someone needs to stop sharing their screen so you can. I'm really looking forward to. There you go. So if we're going to show anything, Eric, have you been in Zoom before?
I think I got it.
Yeah, it's that green button there. Okay.
Let's see. Can you see my
got it.
coincident economic trends here?
Yeah. So this is a great time because, I went to your website and you think we're nearing an inflection point. But before that, can you tell us a little bit about how you got involved in doing this type of analysis and, how your journey began as a market analyst? It looks like you're an economist. So tell us about, was it something you always wanted to do, or was it an accident? How did it happen for you, buddy?
Yeah, sure. So I mean, it was a passion of mine for a long time. I studied economics at New York University, and right after school, I jumped straight to the buy side, and I went to work at a quant fund in Midtown, trading fund traded equity derivatives. And it was a little bit outside of the area of my study. This fund wasn't particularly focused on economics at all. It was all statistical analysis, but it gave me a great chance to work on some of those programming skills, some statistical skills. So in the background, while I was there for a couple of years, I was continuing my economic research and implementing a lot of these statistical techniques that I was learning. Did a lot of work on long-term secular economic trends and debt deflation. And I married that with some shorter-term research on what we call cyclical economic trends. So after a couple of years of doing this work in the background, I decided to leave the fund and start publishing this research on my own. And I quickly gained a pretty good following of market participants that found value in these long-term and short-term economic trends and how they relate to asset markets. So that's how I got going. And it's been over 5 years now.
Okay. So does this give you, this kind of information gives you a bias and a narrative to trade off of? Because, I've talked to Jack Schwager, and, fundamental research is great, but it really doesn't tell you where you're wrong. So, the risk management part, what's actionable about even short-term industrial production and the consumption and adjusted real income? How do you apply that to, say, for example, what's happening in the markets right now, making new record highs, had a nice break last week and threatening again to make another high, stalling out here. How do you apply it to the market?
Sure. So with economic analysis, there's a couple things to consider. First is that you can't go shorter than a 6-month time duration if you're trying to use economic fundamentals to help you, because anything shorter than that doesn't give economic fundamentals a chance to play out. So you have to extend your time horizon a little bit. And for me, the shortest window of time that I play in is that 6 to 18 month window. And the reason that that's important, and these indicators on the screen are important, is because asset markets, whether it's specific asset classes or sectors, have radically different performance when the growth rate of these indicators is trending higher and when the growth rate of these indicators is trending lower. And what I mean by that is we can combine these 4 indicators into one composite. And that composite is basically our outline of the economic growth rate in the economy. And you can see here how the growth rate for quite a while was trending straight higher. And around April, the growth rate pivoted and it's now heading lower. If I extend the chart a little bit, you can see the black line, how it tracks real GDP growth and how it moves in cycles. There's periods, there's 6 to 18 month windows where the growth rate is trending higher, and there's 6 to 18 month windows where the growth rate's trending lower. There's obviously oscillations in between, but we're only concerned with the 6 to 18 month trend.
Well, maybe I finally, excuse me, maybe I finally met somebody that could explain to me, well, I'm sure why we've had dramatic performance in the S&Ps and NASDAQ. And since the time frame you mentioned, April, the Russell 2000 has gone nowhere, sideways, hasn't made a new high since that time frame. Is there something there that you're seeing fundamentally, economically, that would explain the underperformance of mainly domestic stocks here in the U.S. and regional banks?
Yeah, so I actually wasn't going to bring this slide deck out, but since we're going here, I think this is really important. So along these economic trends, what I was saying before,
you have to do a new share, Eric. I just see your name up there.
Okay.
So
I'm sorry about that.
Okay.
Live TV. I think we got it now, right?
Yeah, there you go.
Okay, so these economic trends, when we study them, there are these 6 to 18 month windows where the growth is accelerating and the growth is decelerating. And we can block these windows off. And what we know is that if we go back over the last 25 years, you could see here, we've blocked these windows off to when the growth rate's accelerating or increasing and when the growth rate's declining. And we can break these periods down. And when the growth rate is trending higher, the S&P has an average annualized return of almost 20%. And when the growth rate's trending lower, the return is just about 4%. And we can go through every single period here. The power of this is it carries to different asset classes. So same thing, but for bonds. When the growth rate is trending higher, bonds don't perform as well. And when the growth rate's trending lower, bonds perform very well. So taking that one step further to the question that you asked, and actually the lead into our interview, one of the panelists was saying, we have this new burst of volatility. Well, what's actually happened? What's the fundamental factor that's changed? Over the last 2 months, we've had an inflection in growth. We've gone from a period where economic growth is increasing to a period where now economic growth is going to start decreasing. And that comes with a shift in what have we been seeing? Radical outperformance of bonds. We've seen underperformance of stocks, but more under the surface, to the question you asked, when growth's accelerating, cyclicals perform well, small caps perform well, the Russell performs well. And when the growth rate is coming down, when the growth rate's decelerating, all of those cyclical sectors, those regional banks, the Russell 2000, those perform worse. So that is why we've had this sudden change of market leadership and performance. There's a fundamental factor behind it. It's not that the growth rates tick down for a month or two. It's the market starting to realize that we're now going through what's likely to be a 6 to 18 month period of growth coming down.
Okay. And so the stocks in the Russell does this speak more to the US, and the other indexes are, multinationals where they can get their growth outside of the US, plus a weaker dollar would help their cause, and the Russell doesn't have that advantage?
Well, what we see is that the U.S. is such a driver of global economic growth that the strength of the U.S. dollar relative to other currencies tends to be very correlated to this growth rate cycle. It's very difficult for the United States to be in a period of declining growth and have the rest of the world have accelerating growth. If the U.S. is declining, most likely all of the industrial economies that support U.S. consumption are going to have declining growth as well. So when we go to these periods of declining growth, it's counterintuitive, but the US dollar tends to strengthen. So that's why when we have periods of declining growth, international actually start to underperform because the dollar tends to rise during these periods of declining growth.
Okay. So with your forecast, does this mean that the dollar, you're constructive the dollar for the next 6 to 18 months?
That's right.
Okay. And bonds. So everyone's talking about inflation. Commodity prices we've had bull markets in commodities, and you can't go anywhere now. Well, at least we can go some places right now. Everything costs higher. Are you still one of the few deflationists out there, Eric?
Yeah. So last time I was on, I outlined my long-term disinflationary thesis, my long-term thesis on why the growth rate in the economy was going to continue to come down. But my shorter-term cyclical forecast, as you see in this chart, was that we were going to see both growth and inflation increase. That's what the leading indicators were saying.
Okay.
That now we've pivoted to, we're still in a long-term disinflationary trend, but now we're going to start to see the growth rate and the inflation rate over the next 6 to 18 months coming down, not going up.
Okay. So some of the moves in commodities for vis-a-vis lumber, giving back 60-70% of its advance, and crude oil, WTI, cracking in the last few weeks. Is that confirmation?
Well, all of those trends are entirely consistent with a growth rate that's coming down. If you went back, back to the other slides that I was showing, the performance of assets during these upturns and these downturns, industrial commodities, as you might imagine, perform really well when the economy is accelerating and perform really poorly when the economy is trending lower. So this inflection point that we've had at April or May, it's been a major inflection point in growth, as you can see in this chart. So there's a fundamental factor behind all of these sudden shifts that we're seeing in the market. It's not happening by accident. It's coinciding with a regime shift in the rate of direction of growth.
Okay, and growth is a lot of people feel the reopening trade is still alive and well. They're saying Delta is not going to be a problem. What do you say to people that point towards the consumer being in great shape, having banked a lot of this aid money, some of them have, and their balance sheet has never been better, which is going to fuel consumer spending? What do you have to say about that?
Okay, well, there's a few things I want to say about that, and this relates to one of the things that we were talking about in the lead-in as well, which is the Fed. So this is real GDP, and the green line is the trend line in real GDP prior to COVID. So the economy was growing at about 2.3%. That was the trend before COVID. Then COVID happened, GDP declined sharply, and now we've snapped back. And this dotted line is where the economy is expected to be after Q2. So the red line will be 1 full year from the low. And what we know in economics is there's a rule called the Zarnowitz rule. And what that tells us is that sharp or deep recessions are followed by sharp recoveries. So the deeper the recession, the sharper the snapback. But the severity of that snapback only occurs in the first year. Then the cycle owes you nothing less. Then you start to revert closer to trend growth. So all of these crazy outsized gains we've made in the economy, the historical research shows that happens in the first year, which is what we see on the chart here. Now we're going to have to grow, or we're going to start to revert towards trend. And what we see is that if we're going to close this gap by the start of 2023, which is only 6 quarters away, we're going to have to grow at a sustained pace of almost 4% for the next 6 quarters. And for a variety of reasons, which we may not have time to get into, that's extremely unlikely given that our prior trend was only 2.3. So what that means is we're going to have a persistent gap. The space between the green line and the blue line is a gap in real GDP, and that's a disinflationary gap. And that shows that the consumer or the economy as a whole hasn't recovered to where we were. And the reason that the market, or specifically the bond market, started to freak out and flatten, the yield curve started to flatten when the Fed made their slightly hawkish move a couple weeks ago, is because the market realized that the Fed was going to be tightening monetary policy with a GDP gap, which is a major problem. They're going to be tightening or stunting the recovery when the recovery hasn't fully caught up to where we were prior to COVID. So when the market pulled that rate hike into 2022, we saw a rate hike built into the curve at the end of 2022. That was the market saying that the Fed was going to raise rates before we've closed this GDP gap. And that's why there's been a significant flattening, and there's been all kinds of reactions to what people think is not a very hawkish Fed, but the economy still hasn't recovered.
So, it seems like, Powell has, been on both sides of the fence on this. And, since his last statement that, we are going to have to taper, has kind of been walking it back a bit. Do you think he's going to follow through with the taper? I've talked to some people that think he may start sooner than the market is anticipating year end, but that it could happen sooner, maybe next month. What do you think? Is Powell going to be more concerned about his legacy, or being renominated as Fed chairman?
If it comes to be a political decision, it's a tough call. So, I can't say which month he's going to start, but what I can say is that any act that shifts in the direction of tightening will be incredibly short-lived and will be reversed quite quickly, particularly if the tightening comes while we have an existing GDP gap. That's going to add disinflationary pressure on top of disinflationary pressure. So the secular or the long-term trends in the economy, pushing growth lower, pushing inflation lower, pushing interest rates lower, those trends are so incredibly powerful that I know that as soon as he moves in the direction of hawkish, we're going to see a reaction in the bond market like we saw, flattening of the yield curve, and that's going to have spillover to all of the other cyclicals. So any tightening action that they take will be very short-lived.
Okay, well, there are people that believe that he already has by, I believe, raising the Fed funds rate, 0.05 from 0.00 to 0.05, and that the banks are having trouble with too much liquidity. They can't keep all the cash on the balance sheet, and that's why they keep doing what we used to call match sales, and they call reverse repos now. Any comment on that?
Yeah, so I don't view it as a tightening. I think it's more of a technical factor to try and avoid the appearance of negative rates, because short-term interest rates probably would be in negative territory already had this had the reverse repos not been available. But basically what's happening here is through fiscal stimulus and through quantitative easing, we're flooding the banking system with deposits. Fiscal stimulus and QE both increase deposits in the banking system. And those deposits generally flow into two places. They can flow into private sector loans, or they can flow into securities and cash assets like reserves or repo and things like that. The loan to deposit ratio shows us that while deposits in the banking system are going up, loans are not. So the banking sector the banking sector is not taking these new deposits and putting them into new private sector loans, which would increase the velocity of money, GDP, all of those things. What they're doing is they're taking the deposits and they're just redeploying it back into various securities, agency securities, treasury securities. And all that's doing is it's keeping the money, it's trapping the money in the financial system. There was this theory before COVID, is that the reason that QE didn't work is because it wasn't QE for the people. Well, if we send checks to people and we do QE, that'll increase the velocity of money because we'll send money to people with a high propensity to consume. Well, we did exactly that and velocity went down. And it has nothing to do with the shutdown because velocity is lower today than it was in Q2 of 2020. And nobody could tell me the economy is not more open today than it was in Q2 of 2020. So there's something fundamental going on here where you can send people money. It can be in their bank account, but that check that appears in your bank account is a deposit in the banking system. And that deposit is not, the bank's not taking that deposit and directing it towards a new private sector loan. They're just taking it, giving you zero and redeploying it into a security and making very little. It's a free spread, but that's what they'd rather do. And
consumers are saving and paying down debt instead of spending?
Yeah, that's right. That's right.
Okay.
So one of the things that we
Where's
can see,
the growth going to come from is the question, right?
That is the question. So this chart here, what's called the marginal revenue product of debt, it basically tells us how much GDP are we generating per dollar of debt. And this is government debt, household debt, corporate debt, and financial debt. And in the 1950s, every dollar of debt was generating about 70 cents of growth. Today, every dollar of debt's generating about 26 cents of growth. So as we continue to try and use more debt to solve a problem of over indebtedness, we're getting diminishing marginal returns, and that's putting us into a downward spiral in economic growth that we won't be able to get out of because the political or the probability of reduced spending or austerity on any level in a modern democracy is quite difficult. So we're probably going to continue to go down this road of increased indebtedness on top of a existing debt problem. And a lot of people believe that that's going to lead to inflation, but really it leads to disinflation or deflation.
Okay. Very interesting, Eric. Does China come into play? Because your earlier statement that, if America is not performing, it's kind of like if we catch a cold, the rest of the world catches pneumonia. But I do recall in the Great Recession, China wasn't as affected by it as much as we were in Europe. And economists were hanging their hat on that China was going to lead us out of that bottom. And China, I believe, has problems of their own that might be kind of similar to this. So you can't have it both ways and say China could pull us out of something. And then if China's having problems that it's not going to hurt or bother the U.S., where do you come down on that?
So China has two major problems, and going forward, they're not going to be the engine of growth that they were. Two problems. One is that they have a major population bust, especially over the next several years because of the one-child policy that they implemented. So we know that trend economic growth is a function of population growth and productivity growth. Their population growth is going to start contracting. I believe it actually private research shows that it actually may have even contracted last year, but their population growth is going to be a problem for them, and it's going to be a problem for the engine of the world going forward. The second problem is the productivity of their debt. So if China decided that they wanted to build a city of 1 million buildings, and they were going to use debt to fund it, which they've done, of course, that's going to increase the price of commodities around the world. I think they heard a statistic that they poured more concrete in a 3-year period than the US did over 100 years. So that level of demand, that outward shift in demand, of course, is going to inflate the whole world. However, that debt, those projects were unproductive projects because they either are, a lot of these infrastructure projects are not generating any cash.
Ghost cities.
Right. So, so this curve, this marginal revenue product of debt, this curve is actually even worse in China because the use of their debt has been more unproductive. If you hire a bunch of people to dig a hole and fill the hole, technically that adds to GDP. Government spending is a line item in GDP, but that doesn't increase the standard of living of the people as a whole. So that's going to register as an increase in debt and an increase in GDP, of which that debt increase generated a lower and lower amount of GDP. So you're going to need larger and larger and larger stimulus packages, infrastructure packages to generate less and less growth. And that's the direction that the US is going, China's going, Japan's going, and Europe's going. All of those major economies basically make up all of the world's growth. So the world is going to move into this really, as we saw in the last economic cycle, but it's going to be even worse this economic cycle, this continued slow grind. And when I make that point, I just want to caveat that this is not a doom and gloom forecast. I don't say this to suggest that there's going to be some major crash or some major explosion. I actually don't think that's the case. I think that the most likely path is a slow grind lower to lower rates, lower growth, more death by 1,000 cuts versus some super explosion.
Okay, and are you recommending larger allocations to the debt markets, to sovereigns, to and less exposure to equities? Would you be changing that?
So the way that I think about asset allocation is that when economic growth is accelerating, so when we're in a trend of rising growth, you want to have more equities than fixed income because equities perform better. And your equities, you want to be tilted towards your cyclical exposures, your materials, your financials, your industrials. Now we're moving over to the right side of this screen where growth is going to be decelerating, or the economic growth rate is going to be coming down. So that means you're going to want to shift, like you said, more towards fixed income, more towards long duration, and your equity exposure, this exposure that you do have, you want to tilt that defensive, like large cap tech, utilities, healthcare, consumer staples, and you want to start to avoid those cyclicals, those industrial commodities, things like that.
Okay, and the high yield junk market, HYG, should that be giving us a signal that things are happening by, I know there's some Fed influence on it after COVID, but HYG, is that an indicator for you, Eric, that you pay attention to?
I don't follow
the spreads.
Yeah, I don't follow it as an indicator of where we might be going, but I would use it as a confirmatory signal. So the fact that we are in an environment where growth's slowing now, I would expect HYG to start having worse performance than it's had over the last 6 to 8 months.
Okay. So do you have subscribers, retail or institutional, and how do people follow your work? I actually have a request, Anthony Aldridge. Yes, there will be a copy of this recording. It will be on Twitter. It will be on our website, and I'll give it to Anthony too. So this is it. This is your contact information.
Yeah, so I have both retail and institutional clients on my website, EPB Macro Research. I publish a lot of research and blog posts for free. I publish a lot of stuff I'm starting to publish more stuff on YouTube. And for those that are interested, on epbmacroresearch.com, I have both a monthly report that I publish, which covers the leading indicators of that short-term cyclical trend that we talked about, sort of discussing where the growth rate is going to be heading. And then I also have a quarterly presentation which I go through the long term, the short term, kind of the whole package once a quarter. So that's kind of what I provide, and this is where you can find me. I'm really active on Twitter, so that's a good place if you want to interact.
Eric, thank you so much. And do you spell Zarnowitz? This is for my copy, Zarnowitz.
That's right.
Okay, so I learned about Zarnowitz as well as many other things, and I appreciate your work and that you're giving spirit to come and share your work with us today for our community.
No, thank you for sharing your platform. It's really
All
appreciate
right,
that.
everyone, you can follow Eric on right here on Twitter at EPB Research and check out his videos. And if you want to be in touch with the fundamentals of what Eric is talking about, he's very good. And I learn every time I talk to you, Eric. Thank you very much.
Thank you very much.
Okay, so that's a wrap, everyone. We'll see you tomorrow. See you, Sinatra. Remember, don't just count your economic indicators, count your blessings, and we'll see you all to wrap it up. You're very welcome, everyone. Thanks again, Eric.